Welcome to this basic bookkeeping and accounting study guide, part 3 of 4 from TestMole.com, where employers can test candidates and teams using pre-built or custom assessments. We also create free tests and guides like this. Please help us by liking this video. Subscribe for more study guides and free tests. And turn on notifications. Okay, let's begin. What is the main benefit of maintaining a sales ledger control account? A Sales Ledger Control Account, SLCA, acts as a summary account for all individual customer accounts in the sales ledger. It records the total value of credit sales, receipts, and returns for the period. By comparing the balance of this control account to the total of the individual customer balances, accountants can verify that the ledger is mathematically accurate. If the two figures do not match, it signals that an error has occurred in the recording process, such as a posting mistake or an omitted transaction. The options are: A. It lists the address of every customer. B. It provides a check on the arithmetic accuracy of the sales ledger. C. It calculates the total VAT on purchases. D. It replaces the need for a trial balance. The answer is B. The SLCA provides a total figure that must reconcile with the sum of individual customer accounts, revealing arithmetic errors. It does not store contact details, calculate VAT, or replace the trial balance, which remains necessary for checking the equality of all debits and credits in the general ledger. How should carriage inwards, delivery costs on goods purchased, be treated in the accounts? Carriage inwards represents the cost of transporting goods from a supplier to the business premises. Because this is a direct cost incurred to bring inventory into a saleable condition, it is considered part of the cost of purchases. In the trading account, this cost is added to the purchase price to determine the total cost of goods available for sale, which is then used to calculate gross profit. Possible answers are: A. As an operating expense. B. Added to the cost of purchases in the trading account. C. Deducted from sales revenue. D. Recorded as a non-current asset. The answer is B. Carriage inwards is a direct cost of acquisition, so it increases the cost of purchases. It is not an operating expense, which are indirect costs, nor is it a reduction of revenue or a non-current asset. Which of the following errors will not cause the trial balance to be out of balance? Select all that apply. A trial balance remains in balance if the total debits equal the total credits. Certain errors do not disrupt this equality because they affect both sides of the ledger equally or omit both sides entirely. Error of omission: the transaction is completely left out of the books. Error of commission: the amount is correct, but it is posted to the wrong account of the same type, e.g., a customer's account. Error of principal: the amount is correct, but it is posted to the wrong category of account, e.g., an expense recorded as an asset. Conversely, a transposition error in only one account creates an imbalance because the debit and credit totals will no longer match. Possible answers are: A. Error of omission. B. Error of commission. C. Transposition error in one account. D. Error of principal. The answer is A, B, and D. Omission, commission, and principal errors involve posting the same amount to both sides or omitting the entry entirely, keeping the trial balance totals equal. A single-sided transposition error changes one side of the ledger, causing an imbalance. If a business sells zero-rated goods, what rate of VAT is charged to the customer? VAT rates are categorized into standard, reduced, and zero-rated. When goods are zero-rated, they are taxable at a rate of 0%. This is distinct from exempt goods, where VAT is not charged because the supply is outside the scope of VAT. For zero-rated items, the business can still reclaim any VAT paid on its own purchases related to those sales, whereas this is generally not possible for exempt supplies. Let's review the options. A. 20%. B. 5%. C. 0%. D. VAT is not applicable, exempt. The answer is C. Zero-rated means the tax rate applied is 0%. It is not the same as being exempt, where VAT does not apply at all. Under the reducing balance method, depreciation is calculated as a fixed percentage of. The reducing balance method of depreciation applies a fixed percentage to the asset's net book value, NBV, each year. The NBV is the original cost of the asset minus the accumulated depreciation already charged. Because the NBV decreases over time, the annual depreciation charge also decreases, resulting in higher charges in the early years of an asset's life and lower charges in later years. Choose between A. The original cost of the asset. B. The net book value carrying amount of the asset. C. The estimated scrap value. D. The total sales of the business. The answer is B. This method uses the reducing net book value as the base for the calculation. Using original cost would be the straight-line method, while scrap value and sales are not used as the base for calculating periodic depreciation. What is a contra entry in the context of a three-column cash book? A three-column cash book tracks cash, bank, and discount transactions. A contra entry is a unique accounting mechanism used when a transaction affects both the cash and bank accounts simultaneously. Because both accounts are held within the same book, the entry appears on both the debit and credit sides to maintain the double entry balance. Common scenarios include cash deposit, withdrawing cash from the till to deposit into the bank. Cash withdrawal, withdrawing cash from the bank for office use. Choose between A. An entry that corrects a previous error. B. Transferring funds between the cash column and the bank column. C. A payment made to a foreign supplier. D. Writing off a bad debt. The answer is B. A contra entry is specifically defined by the movement of funds between cash and bank accounts. Other options describe unrelated processes. Error corrections are journal adjustments, foreign payments are standard bank transactions, and bad debts are written off through the sales ledger and bad debt expense accounts. Which accounting principle requires inventory to be valued at the lower of cost and net realizable value? The prudence principle, also known as conservatism, dictates that accountants should exercise caution when preparing financial statements. It ensures that assets and income are not overstated and liabilities and expenses are not understated. Valuing inventory at the lower of cost and net realizable value is a direct application of this principle. If the market value of inventory drops below what you paid for it, you must record the loss immediately, even if the goods haven't been sold yet. This prevents the business from showing an inflated asset value on the balance sheet. Let's review the options. A. Going concern. B. Prudence. C. Consistency. D. Materiality. The answer is B. Prudence requires anticipating losses but not profits, justifying the lower of cost or market approach. Going concern assumes the business will continue, consistency ensures uniform methods over time, and materiality focuses on whether an item is significant enough to influence economic decisions. An unpresented check is a check that has been. Bank reconciliation is the process of matching the business's internal cash book records with the bank statement provided by the financial institution. An unpresented check or outstanding check occurs when a business writes a check to a supplier and records it in their books, but the supplier has not yet presented it to the bank for payment. Consequently, the bank balance remains higher than the cash book balance until the check clears. Choose between A. Written by the business but not yet processed by the bank. B. Received from a customer but not yet deposited. C. Returned by the bank as refer to drawer. D. Lost in the post. The answer is A. Unpresented checks are payments already recorded by the business, but not yet processed by the bank. Other options refer to different reconciliation items. Checks received but not deposited are lodgements not yet credited, and refer to drawer refers to dishonored checks. What is the double entry for paying net wages from the bank account? Wages represent an operating expense for the business. Under the double entry system, every transaction must have a debit and a credit of equal value. Debit, wages expense, increases the expense account, reflecting the cost incurred by the business for employee services. Credit, bank, decreases the asset account, as cash is leaving the business to pay the employees. This entry ensures the profit and loss account correctly reflects the cost of labor, while the balance sheet shows the reduction in cash reserves. Possible answers are A. Debit wages expense, credit bank. B. Debit bank, credit wages expense. C. Debit trade payables, credit bank. D. Debit drawings, credit bank. The answer is A. Wages are an expense, debit, paid via bank credit. Other options are incorrect because debiting bank would imply receiving money, while debiting trade payables or drawings would incorrectly classify the nature of the transaction. If the owner takes goods from the business for personal use, what is the credit entry? When an owner takes goods for personal use, it is classified as drawings. Since these goods were originally purchased for resale, the business must remove them from the purchases account to ensure the cost of goods sold is accurate. Debit, drawings, increases the owner's withdrawal account. Credit, purchases, reduces the total cost of goods available for sale. This effectively treats the goods as if they were never bought for the business in the first place, rather than treating them as a sale. Possible answers are A. Credit sales. B. Credit purchases. C. Credit bank. D. Credit inventory. The answer is B. Crediting purchases is the standard method to remove the cost of goods taken for personal use. Crediting sales would be incorrect because no revenue was generated, and crediting inventory or bank does not reflect the reduction of the original purchase cost. If output tax is £5,000 and input tax is £3,500, how much is payable to HMRC? VAT, value-added tax. Accounting relies on the difference between the tax collected from customers and the tax paid to suppliers. Output tax, the VAT collected on sales, which the business owes to HMRC. Input tax, the VAT paid on business purchases, which the business can reclaim from HMRC. The net amount payable is calculated as output tax. Input tax equals VAT payable. Choose between A. £5,000, B. £3,500, C. £1,500, D. £8,500. The answer is C. Subtracting the input tax of £3,500 from the output tax of £5,000 leaves a net liability of £1,500. The other options represent either the gross tax collected, the gross tax reclaimed, or an incorrect sum. The impressed amount in petty cash refers to. The impress system is a method of managing petty cash to maintain control over small, frequent expenses. A specific amount, the impressed float, is set aside. As expenses are paid, vouchers are collected. At the end of the period, the business reimburses the fund for the exact total of the vouchers. This restores the cash balance back to the original fixed amount. The options are A. The total of the vouchers spent. B. The fixed balance the fund is restored to each period. C. The amount of interest earned on cash. D. The amount stolen from the safe. The answer is B. The system is designed to keep the fund at a constant, predetermined level. Vouchers represent spending, not the balance, and the system is unrelated to interest or theft. Which of these are classified as non-current liabilities? Select all that apply. Liabilities are obligations a business must settle. They are categorized by their maturity date. Non-current liabilities, debts or obligations due to be settled more than 12 months after the reporting date, e.g., long-term loans, mortgages. Current liabilities, obligations due within 12 months, e.g., trade payables, bank overdrafts. The options are A. 10-year bank loan, B. Trade payables, C. Mortgage, D. Bank overdraft. The answer is A and C. A 10-year loan and a mortgage are long-term financial commitments exceeding 1 year. Trade payables and bank overdrafts are short-term obligations and are classified as current liabilities. What is an error of commission? Accounting errors occur when transactions are recorded incorrectly. An error of commission happens when the entry is made to the correct class of account, e.g., a personal account, and the correct side, debit or credit, but the specific account name is wrong. Example, recording a sale to J. Smith instead of J. Smith. Contrast, an error of principle involves using the wrong category entirely, such as recording an asset purchase as an expense. The options are A. A transaction posted to the wrong type of account, e.g. asset versus expense. B. A transaction posted to the correct side in class, but the wrong personal account. C. Failing to record a transaction entirely. D. Recording the debit and credit in the wrong way round. The answer is B. This is the definition of an error of commission. Posting to the wrong account class is an error of principle, failing to record is an error of omission, and swapping debits/credits is an error of original entry. If a customer pays a debt that was previously written off, where is the credit entry made? When a debt previously written off as bad is suddenly paid, the business must reverse the write-off. Since the debt was already removed from the trade receivables ledger, the cash received is treated as a gain or income for the period. Debit, cash/bank, money coming in. Credit, bad debt recovered, an income account in the statement of profit or loss. Here are the options. A. Trade receivables. B. Bad debt recovered, income. C. Sales. D. Discounts allowed. The answer is B. Crediting bad debt recovered recognizes the unexpected income. It cannot be credited to trade receivables because that account was cleared when the debt was originally written off. Working capital is calculated as. Working capital measures a company's short-term financial health and operational efficiency. It represents the liquidity available to meet immediate obligations within the next 12 months. Current assets, cash, accounts receivable, inventory, and other assets expected to be converted to cash within a year. Current liabilities, debts or obligations due within 1 year, such as accounts payable and short-term loans. If current assets exceed current liabilities, the company has positive working capital, indicating it can comfortably cover its short-term debts. Here are the options. A. Current assets minus current liabilities. B. Total assets minus total liabilities. C. Fixed assets minus long-term loans. D. Cash plus inventory. The answer is A. Working capital is specifically defined as the difference between current assets and current liabilities. Other options, such as total assets minus total liabilities, represent equity, while cash plus inventory ignores liabilities entirely. Which of the following accounts normally has a debit balance? In accounting, The Dead Seal C mnemonic helps remember which accounts normally carry a debit or credit balance. Debits: expenses, assets, drawings. Credits: liabilities, income, revenue, capital. Purchases are an expense to the business, and since expenses increase with a debit, they normally hold a debit balance. Conversely, capital, trade payables, liabilities, and purchase returns, which reduce expenses, are all credit balance accounts. Let's review the options. A. Purchases. B. Capital. C. Trade payables. D. Purchase returns. The answer is A. Purchases are an expense, which follows the debit rule. Capital and trade payables are equity and liability accounts respectively, which carry credit balances, and purchase returns act as a contra expense, also carrying a credit balance. What is the primary focus of the statement of cash flows? The statement of cash flows provides a bridge between the accrual-based income statement and the cash position of the business. It categorizes cash movements into three distinct activities. Operating: cash generated from core business activities. Investing: cash used for or received from long-term assets like equipment. Financing: cash flows related to debt, equity, and dividends. Unlike the income statement, which shows profit, including non-cash items like depreciation, this statement focuses strictly on the actual inflow and outflow of cash. Let's review the options. A. To show the net profit of the year. B. To show the sources and uses of cash during the period. C. To list the value of the company buildings. D. To calculate the tax on dividends. The answer is B. This statement tracks the movement of cash, not accounting profit. Other options describe the income statement, profit, the statement of financial position, assets like buildings, or specific tax calculations. To record a telephone expense accrual at year-end, which entry is made? Accruals ensure that expenses are recorded in the period they are incurred, regardless of when the cash is actually paid. This follows the matching principle of accounting. When a service, like telephone usage, is consumed but not yet invoiced or paid at year-end, the business must recognize the expense and create a corresponding liability, the accrual. The entry increases the expense, debit, and increases the liability, credit. Here are the options. A. Debit telephone expense, credit accruals. B. Debit accruals, credit telephone expense. C. Debit bank, credit accruals. D. Debit telephone expense, credit bank. The answer is A. Debiting the expense recognizes the cost in the current period, and crediting the accrual creates the liability. The other options are incorrect because they either reverse the entry, involve cash, which hasn't moved yet, or incorrectly credit the expense. Net realizable value is the estimated selling price less. Net realizable value (NRV) is a conservative valuation method used primarily for inventory. According to accounting standards, inventory must be valued at the lower of cost, or NRV. NRV is the amount a business expects to receive from the sale of an asset after accounting for the costs necessary to get that asset into a sellable state. This ensures that assets are not overstated on the balance sheet if their market value has declined below their original cost. Here are the options. A. Original cost. B. Estimated costs to complete and sell. C. Depreciation. D. VAT. The answer is B. NRV is defined as the estimated selling price minus the costs to complete and sell. Original cost is the baseline for comparison, while depreciation and VAT are irrelevant to the specific calculation of realizable value. The Purchase Day Book is used to record. The Purchase Day Book, also known as the Purchase Journal, is a prime entry book used specifically for credit transactions. It acts as a chronological record of invoices received from suppliers for goods intended for resale. Key scope: only credit purchases of inventory are recorded here. Exclusions: cash purchases are recorded in the cash book, and purchases of non-current assets, like machinery or vehicles, are recorded in the general journal, as they are not part of the core inventory trading cycle. Let's review the options. A. All purchases of any kind. B. Credit purchases of goods for resale. C. Cash purchases only. D. Purchases of non-current assets on credit. The answer is B. Credit purchases of goods for resale is correct because it defines the specific purpose of the day book. Cash purchases belong in the cash book, and non-current assets are recorded in the general journal. Identify intangible assets from the following list. Select all that apply. Intangible assets are non-physical assets that provide long-term economic value to a business. Unlike tangible assets, they cannot be touched or seen but are identifiable and controlled by the entity. Asset type examples: intangible goodwill, trademarks, patents, copyrights. Tangible, non-current, delivery vans, buildings, machinery. Current inventory, cash, accounts receivable. Choose between A. Goodwill, B. Trademarks, C. Delivery vans, D. Inventory. The answer is A and B. Goodwill and trademarks are correct because they lack physical substance while representing future economic benefits. Delivery vans and inventory are tangible assets. What is an error of omission? An error of omission occurs when a transaction is entirely left out of the accounting records. Because the transaction is never entered into the books, it does not affect the balance of the trial balance, making these errors particularly difficult to detect through routine checks. Contrast with other errors. Error of commission: posting to the wrong account of the same type. Error of principal: posting to the wrong class of account, e.g., treating an expense as an asset. Error of original entry: recording the wrong amount. Let's review the options. A. Recording a transaction twice. B. Completely failing to record a transaction in the books. C. Posting to the wrong side of the account. D. Miscalculating the total of the sales day book. The answer is B. Completely failing to record a transaction is the definition of an omission. Other options describe different types of errors, such as errors of original entry or clerical errors. What does liquidity refer to in a business context? Liquidity measures a company's financial health regarding its immediate obligations. It assesses how easily a business can convert its current assets into cash to pay off short-term liabilities, debts due within 1 year. High liquidity: the business can easily pay its bills. Low liquidity: the business may struggle to meet short-term commitments, even if it is technically profitable on paper. The options are A. The ability of a business to make a profit. B. The ability of a business to meet its short-term debts as they fall due. C. The total value of its fixed assets. D. The speed at which it can produce goods. The answer is B. The ability to meet short-term debts is the standard definition of liquidity. Profitability refers to earnings performance, not the immediate availability of cash to cover liabilities. A business has a bank overdraft. In which section of the trial balance will the balance appear? In accounting, a bank account typically holds a debit balance, an asset. However, a bank overdraft occurs when the account balance falls below zero, meaning the business owes money to the bank. Debit balance represents money the business owns, asset. Credit balance represents money the business owes, liability. Because an overdraft is a liability, it is recorded on the credit side of the trial balance. Let's review the options. A. Debit. B. Credit. C. Drawings. D. Non-current assets. The answer is B. A bank overdraft is a liability because it represents money owed to the bank. Liabilities always carry a credit balance in the trial balance. Thanks for watching. With TestMole.com, you get everything in one place, from easy candidate invites and role-based access, to deep analytics and built-in anti-cheat mechanics. We'll assess code answers, free text responses, and issue verified certificates. Ready to simplify your hiring? Give TestMole a try. And one more thing. If you like this video and want to see more, don't forget to like and subscribe.